that there's no solution to the U.S. government debt short of bringing to the table 300,000 tons of gold. Let me repeat that. $34 trillion is about 300,000 tons of gold. Unless that happens, we've got a threat of embargo, we got a threat of depression, we got a threat of huge hyperinflation, we got a threat of massive shortages.
In today's news recap, gold jitters. According to our gold return attribution model, the primary driver for gold's decline was a strong rally in the U.S. dollar index, which finished the year at its high. Softening gold's drop were a rise in break-even inflation expectations and the geopolitical risk index, likely on the back of martial law declared in South Korea, as well as small global gold ETF inflows. Global gold ETFs eked a U.S. $778 million gain in flows thanks to strong Asian ETF buying, significantly offsetting outflows in North America during December. Those outflows were quite benign given the weakness in November and the prospect of profit-taking following such a strong year. A positive sell-side outlook for gold probably helped constrain a bigger end-of-year shift out of gold. Bonds are set to stay on shaky ground, and this should help gold at the margin short-term. Gold may need to consolidate in Q1 2025 as technical signal that it resides in overbought territory. Additionally, Fed puts punch bowl back in the fridge. A 25 basis points Fed policy rate cut in December, doused with further hawkish guidance, resulted in sizable intraday wobbles in equities, U.S. Treasuries, and gold. The S&P 500 fell by 3%, and the 10-year Treasury yield marked the largest FOMC meeting move since 2013. Gold dropped by over 2%. Undoubtedly, the Fed's sober messaging prompted some investors to take profit following a stellar year for equities and gold, with tax loss selling an additional incentive to cut equity exposure. A high rate of uncertainty. The reaction probably also reflected some pent-up uncertainty that markets, as well as the Fed, soon face a change in personnel at the helm of the U.S. economy come January 20th. While the FOMC members are somewhat confident in where interest rates will be at the end of 2025, they are unusually divided on where rates will be at the end of this cutting cycle. Before we dive into the best clips of the week, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
We're going to see some shockwaves, and it's going to be interesting. One of the shockwaves coming, and real soon, Jesse, is countries and companies want to bring their subsidiaries and invest in the United States, but we don't have an adequate skilled labor force, short of 300,000 tons. Remember, Fort Knox was a little under 10,000. So we're talking about 300 times Fort Knox's, more than that. There is a possibility that something like that might happen. And it could be Philippine gold. I have 2 or 3 different contacts who've let it be known to me that Philippines has 1.3 million tons of gold and it's being hidden. But here's a weird phenomenon, Jesse, and this is, you got to get practical when you're talking about political solutions. It could be that we're going to see Gresham's law come to the table, come to the fore. The best money will be held back. and the poor quality money will be brought forward. In other words, if you've got treasury bonds and you want to redeem them, well, we've got cash and we'll print it. We'll print some money for you. That's the lowest quality money. And if you reject that, well, maybe we'll offer you some resources like, super tankers of oil. And there was a phenomenon over a year ago. There were 20 super tankers parked at U.S. ports, and they're all loading up. And a colleague of mine said, Jim, they're getting credits for imports. The U.S. is now getting credits for imports by loading up oil super tankers, and it will not last long, and it will not be sufficient. We're getting to the point where we can't pay for our imports, and we don't have sufficient industry, and we can't reindustrialize because we don't have sufficient skilled labor. This is going to get very ugly, very dicey, very fast.
In today's news recap, silver price surges to near $29.50 due to increased safe haven demand. Silver price extends its gains for the third successive day, trading around $29.60 per troy ounce during the Asian hours on Friday. This sustained rally is attributed to strong safe haven demand amid persistent geopolitical tensions in the Middle East and the prolonged Russia-Ukraine conflict. Axios referenced three sources indicating that U.S. President Joe Biden reportedly explored contingency plans to target Iran's nuclear facilities if Tehran advanced significantly in developing a nuclear bomb before Donald Trump's inauguration on January 20th. These talks underscore the growing concerns over Iran's nuclear aspirations during the transition between administrations. A Financial Times report noted that the People's Bank of China, PBOC, anticipates an interest rate cut this year at an appropriate time. Traders are closely monitoring the potential recovery in China's economy and its effect on the industrial demand for silver. President Xi Jinping reaffirmed his commitment on Tuesday to prioritizing economic growth, promising more proactive policies to bolster China's economy in 2025. While China's manufacturing activity showed minimal growth in December, services and construction sectors have recovered. The data indicates that policy stimulus is beginning to impact certain sectors as China prepares for new trade risks stemming from tariffs proposed by U.S. President-elect Donald Trump. Before we dive into the best clips of the latest interview, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
And he says that the foreign nations holding treasury bonds will redeem them with the U.S. Treasury Department. And the Treasury Department will hand them coupons. And the coupons will be valid to buy stocks and bonds in the United States financial markets. And that will, I think, coincide with the capitalization of new industries, plant, and equipment. Okay, but when you talk about new industries and the financing and plant and equipment, what are you lacking? What's missing? A labor force. I'm telling you, we're going to have a problem with our labor force. It's not going to be a problem with bringing back, say, the auto workers to reinvigorated plants that get a little retooling and take 3 to 6 months for some retooling. No, that's not going to be the problem with the big three, Chrysler, Ford, General Motors. That's not going to be a problem for them. They're going to be happy to do it. They're going to be happy to move it back from Mexico. The problem is going to be the new entries. And many of the new entries are going to want to focus on the hot industries like artificial intelligence, robotics. So we may get, Jesse, this is ugly stuff. We may get new industries coming in that build robotics that wipe out American jobs. Oh my gosh, this is going to get very complicated. And, you know, this is going to be an ongoing topic of study. I would like to see some of the basic industries, and I've outlined some of them in my recently posted December report. I have a monthly report. I call it the hat trick letter just because there are three key parts to it. Just a name, but it's on golden-jackass.com. But I outlined that we need to bring back construction for housewares. You know, plates, glasses. You know, I recently bought a drying bin where you put plates and on the side your silverware. It's not made in the United States. It's made in China.
That's a wrap for this episode. What do you think of Jim Willie's take on the economy, BRICS, and the future of the U.S. dollar? Do you agree with his predictions, or do you see things playing out differently? Share your thoughts in the comments below. I'd love to hear from you. And now, watch this video right here. It's the perfect follow-up to everything we've discussed today. I'll see you on the other side.